If you have ever felt that your paycheck disappears faster than it should, I want you to understand something very simple and very important. There is a reason that happens. And ironically, it is the same reason a small weekly investing habit can eventually become more powerful than many full-time jobs. Time works against your paycheck, but time can work for your investments. Once you understand that distinction, a lot of financial confusion begins to disappear. Most people look at money as a monthly problem. They ask whether they can cover rent, groceries, the car payment, insurance, and the next bill. They think in terms of what leaves the account this week and what comes in next week. That is understandable. When pressure is high, the mind naturally narrows. It focuses on survival. It focuses on the next expense. But the financial machine does not only operate week by week, it operates through cycles, compounding, inflation, wages, market crashes, recoveries, dividends, and time. If you only think in terms of the next paycheck, you are playing a game that inflation usually wins. If you learn to think in terms of ownership and compounding, you begin playing a different game. That is why I want to walk you through the logic of a small weekly habit, not a dramatic investment, not a heroic sacrifice, not some impossible strategy that requires you to already be wealthy. Just a steady habit. $35 a week at first. That number feels too small to matter. It feels like the kind of amount that disappears into coffee, food delivery, subscriptions, or a few careless purchases. But in the right system with enough time, that same small habit can become a portfolio that does what your paycheck cannot do. It can keep working when you are not working. It can keep growing while you are sleeping. It can keep reinvesting dividends into more ownership. It can slowly turn from a habit into an engine. And once that engine gets large enough, it can produce more monthly income than many people earn from a job. That is not magic. That is compounding. But before we talk about the upside, we have to understand the pressure that makes the habit necessary. Most people hesitate with weekly investing because the number looks too small. $5 a day, $35 a week. They look at that and say, how could that possibly change my life? That reaction is normal, but it usually comes from the wrong comparison. They compare $35 to the size of their problems. They compare it to rent, they compare it to groceries, they compare it to the cost of a car, a mortgage, or retirement, and of course it looks tiny. But the real comparison is not between $35 and your current expenses. The real comparison is between money that disappears forever and money that becomes ownership. Those are two very different outcomes, because the environment around the average worker has become much harder. Food, borrowing costs, and basic living expenses have moved faster than many paychecks. You can see it in the food data since 2020. Food prices rose 3.45%, then 3.94%, then jumped a painful 9.95% in 2022. Then they slowed to 5.76% in 2023, 2.26% in 2024, and 2.45% in 2025. That is a lot of numbers, but the lived experience is very simple. The $20 of groceries you bought in 2020 costs about $25.32 in 2025. That is not an abstract statistic. That is something you feel every time you walk through a grocery store. It is the quiet loss of purchasing power. The bag gets smaller, the receipt gets larger, and your paycheck does not always move fast enough to close the gap. At the same time, borrowing money became more expensive. Interest rates that were near zero in 2020 climbed to about 4.09% by late 2025. That changes everything for ordinary households. Mortgages feel heavier, car loans feel heavier, credit card balances become more dangerous. The cost of carrying a mistake goes up, the cost of needing time goes up. That is how the system squeezes people. Wages may rise, but not always in a way that gives people real relief. Wage growth around 3.8% in the 25th of May sound fine on paper. But if prices have already risen sharply over several years, the person receiving that paycheck may still feel behind. This is why people feel as if they are working harder and standing still. Their income is moving, but the ground under them is moving too, and sometimes it is moving faster. That is the first principle. Your paycheck is an income stream, but it is also vulnerable to inflation. If you only depend on a paycheck, you are depending on something that must constantly outrun rising costs. Your investments are different. A well-structured investment portfolio is not just cash sitting still. It is ownership in businesses, markets, dividends, and growth. When the economy expands over time, the portfolio can participate in that expansion. That does not mean it moves in a straight line. It never does. Markets crash, they recover, they fall again, they frighten people, they make people impatient, they test whether you understand what you own. But if you look at the long-term history of the market, the pattern is clear. The Great Depression, the dot-com collapse, the 2008 financial crisis. The COVID crash, the inflation-driven decline in 2022, all of these moments felt severe in real time, and they were severe, but the long-term trend still moved upward. That does not mean the future is guaranteed. It does mean that the person who understands cycles behaves very differently from the person who reacts to every headline. The investor does not need to predict every crash. The investor needs a system that can survive the crashes. That is why weekly investing is so powerful. You do not have to predict inflation. You do not have to call the market top. You do not have to know the perfect bottom. If prices rise, your weekly deposit still goes in. If prices fall, your weekly deposit buys more shares at lower prices. If the market eventually recovers, the shares you bought during fear can become some of the most valuable pieces of the whole journey. The behavior is simple, the effect is not. This is one of the great paradoxes of investing. Many people want complicated strategies because they think complexity must produce wealth. But wealth is often built by doing simple things consistently while other people stop. When the average paycheck grows around 3 to 4% a year and a long-term portfolio historically has had the ability to grow faster than that over time, something important begins to happen. Your labor income may pay your bills, but your investment income begins building a second system. At first, the second system is tiny. Then it becomes noticeable. Then it becomes meaningful. Then if you keep going long enough, it can begin competing with your paycheck, and eventually it can surpass it. That is the purpose of the $35 habit. It is not about the size of the first deposit. It is about building the machine. Let me show you the early part of that machine because this is where most people quit. Imagine someone investing $20 every week. That is $1,040 per year for many people. That amount does not feel serious. It feels too small. It does not produce dramatic results in the beginning. In year one, you put in $1940. The account starts moving, but not much. Dividends may begin to reinvest. Market growth may add a little, but the balance does not feel life-changing. That is why most people underestimate it. They judge the early years by how they feel rather than by what they are building. By year 3, total contributions reach $3,120. With dividends reinvested and early deposits having some time to grow, the balance might be around $3,750. Again, it does not look like a miracle. But something has changed. Part of the account now came from the account itself. That is the beginning of the snowball. By year 5, total contributions reach $5,200. But the account might be closer to $6,850. Now the snowball has weight. Each new weekly deposit lands on a larger base. Each dividend buys more ownership. That new ownership produces more future dividends. And those future dividends buy even more ownership. The first 5 years are not explosive. They are foundational. They are the part of the story nobody wants to watch because the curve still looks flat. But the curve is forming, and once the curve forms, it can do things that straight-line thinking cannot understand. This is the mental problem most people have with compounding. Human beings think linearly. They expect a straight line. They expect to put in a little and see a little result, then put in more and see a slightly bigger result. But compounding does not behave that way. Compounding is slow, then meaningful, then surprisingly powerful. The danger is that the boring stage happens first, so people stop before the machine has had enough time to show itself. They invest for 6 months and ask why they are not rich. They invest for a year and get discouraged. They see a market drop and assume the system is broken. They look at the balance every week and treat normal volatility like a verdict on their future. That is a mistake. The correct question is not, did my balance rise this week? The correct question is, did I invest this week? That is the part you can control. You cannot control inflation. You cannot control interest rates. You cannot control short-term market movements. You cannot control whether the next headline frightens investors, but you can control whether the habit continues. And that is where real discipline lives. The great shift happens when you stop asking whether this is growing fast enough and start asking whether you are building the system correctly. Did the money go in? Did the dividends reinvest? Did you avoid panic selling? Did you stay consistent during the dull months? Did you stay consistent during the scary months? If the answer is yes, the system is working even before it feels exciting. That mindset matters because once the mindset is in place, the investment selection becomes less emotional. You stop chasing whatever is hot. You stop trying to find the perfect fund. You stop thinking the goal is to outguess everyone else. Instead, you begin looking for qualities that can survive time. The first quality is diversification. Diversification means you are not betting your future on one company, one product, one management team, or one prediction. When your portfolio owns hundreds or thousands of businesses, one failure cannot destroy the whole plan. One company can struggle while another company grows. One sector can cool while another leads. That is why broad index funds are so useful. They give you wide coverage automatically. You do not have to identify every winner in advance. You own the system. The second quality is broad exposure. This is different from diversification. Diversification asks how many things you own. Exposure asks what kinds of things you own. Markets rotate. Large companies lead in some periods, mid-sized companies lead in others. Growth companies dominate for a while, then income-oriented companies become more important sustainable businesses. And future-facing sectors may perform differently from traditional sectors. A strong long-term portfolio should not depend on one narrow bet. It should have exposure to different company sizes, sectors, and styles, so it can keep participating as leadership changes. The third quality is real historical performance. I do not mean hype. I do not mean a story that sounds exciting. I mean funds built on companies that have shown the ability to grow earnings, strengthen fundamentals, and reward shareholders over time. The fourth quality is dividend growth. Dividends are often misunderstood. People think of them as small payments. But when they are reinvested over long periods, they become one of the engines of compounding. A company or fund that increases dividends over time creates a rising stream of cash flow. When those dividends buy more shares, the loop strengthens. More shares produce more dividends buy more shares. That is the income snowball. The fifth quality is low cost. Fees are quiet. They do not feel dramatic in 1 month or 1 year, but over decades they can take enormous amounts of money away from the investor. A low-fee or zero-fee fund lets more of the return stay inside the machine. And if compounding is the engine, fees are friction. Reduce the friction, keep more working. That is why the Fidelity funds in this portfolio fit the logic. The point is not to pretend there is one magical product. The point is to create a system that combines broad market exposure, mid-cap growth, sustainable growth, income, dividend growth, and low cost. The first fund is FROX, the Fidelity Zero Total Market Index Fund. This is the core. It gives exposure to the full U.S. stock market, large companies, mid-sized companies, small companies, and every major sector. Its purpose is simple: track the U.S. stock market with zero management fees. That matters because the core of a portfolio should not be fragile. It should not depend on one narrow prediction. It should cover the base of the economy. In this example, FROX has a 1.04% yield, dividend growth of 7.55% per year, and annual price appreciation of 13.5%. Those numbers are not promises about the future. They are inputs into the projection and a way of understanding what the fund has been doing. Its role is foundation. It gives the portfolio broad participation in the market. The second fund is FSMDX, the Fidelity Mid-Cap Index Fund. This fund focuses on medium-sized companies. These are not the smallest and riskiest businesses, and they are not the largest and most mature. They sit in the middle where many companies are established enough to be real but still have room to expand. That is a useful role in a portfolio. Mid-cap exposure gives the portfolio access to companies that may still be climbing. In this example, FSMDX holds around 300 companies across technology, industrials, consumer sectors, and finance. It has a 2.42% yield, dividend growth of 17.21%, and annual appreciation of 7.4%. Its role is expansion. It adds a different stage of growth to the portfolio. The third fund is FITLEX, the Fidelity U.S. Sustainability Index Fund. This gives the portfolio a modern edge. It invests in companies screened for environmental, social, and governance practices, including many leaders in technology, healthcare, and communications. The important point is not to use a label as a substitute for thinking. The important point is that this fund adds exposure to companies and sectors that have shown momentum in the modern economy. In this example, FITLEX has a 1.14% yield, dividend growth of 13.74%, and annual appreciation of 13.06%. Its role is resilience and future-facing growth. The fourth fund is FGRX, the Fidelity Growth and Income Portfolio. This brings balance. It invests mostly in high-quality, large-cap companies with stable earnings. It is designed to combine reliable dividend payers with consistent growers. That balance matters because an investor does not only need growth, an investor also needs a structure that can continue producing cash flow over time. In this example, FGRX has a 3.13% yield, dividend growth of 19.68%, and annual appreciation of 8.17%. Its role is to lift both sides of the portfolio, income and growth. The fifth fund is FDGFX, the Fidelity Dividend Growth Fund. This is the income stabilizer. It focuses on companies with long histories of raising dividends and strong financial fundamentals. It is not designed to be the fastest part of the portfolio. Its job is to strengthen the compounding of dividend income year after year. In this example, FDGFX has a 3.2% yield, dividend growth of 18.03%, an annual appreciation of 2.78%. Its role is stability and rising income. Now put those five together. You have a broad total market fund, you have mid-cap growth, you have sustainability and future-facing exposure, you have growth and income, you have dividend growth. That is not a random list, it is a portfolio structure. And once you have a portfolio structure, you can calculate what it is designed to do. If we treat each fund as an equal slice, we can calculate the average dividend yield simply FRATS at 1.04%, FSMDX at 2.42%, FIDELX at 1.14%, FGRX at 3.13%, FDGFX at 3.2%. Add them together and you get 10.93, divide by 5 and you get 2.186%, rounded to 2.19%. That is the average portfolio dividend yield in this simple equal-weighted example. You can apply the same method to the average dividend growth rate and the average annual share price appreciation. Add the five numbers. Divide by 5 using that method, the portfolio produces an average dividend growth rate of 15.24% and an average annual share price appreciation of 8.98%. Those numbers matter because the portfolio is not only designed to rise in value, it is also designed to increase what it pays over time. That combination is where the long-term projection becomes powerful. Now let us look at Josh. Josh invests $5 a day, that is $35 a week, because the portfolio has 5 funds. That is basically $1 going into each fund every day. That sounds almost too small to mention. But that is the lesson. Most wealth-building habits look unimpressive at the start. By the end of year 1, Josh has contributed about $1,825. That is the foundation. There is no great celebration yet, no one around him notices. His life does not suddenly look different. He has simply started building the machine. By year 10, the portfolio is projected to reach about $32,000, with reinvested dividends beginning to build real momentum. At this point, the difference between contribution and compounding becomes visible. The account is no longer just what Josh paid in. It is now what the system has started producing. By year 20, Josh has contributed $36,500 in total. But because of long-term compounding, the portfolio is projected to reach about $160,000 and generate nearly $9,000 per year in dividends. Now the machine is real. It is not yet replacing a full-time job, but it is producing money that Josh did not earn by working more hours. That matters. Because once investment income begins to appear, your relationship with labor starts to change. You are no longer only selling time. You now own something that pays you because it exists. Then comes the final decade. This is where compounding shows its strength. By year 30, Josh's portfolio is projected to reach about $942,000. At that level, the portfolio could pay around $98,000 per year, or about $8,000 per month in dividends alone. Think about the structure of that outcome. Josh contributed $54,750 out of his own pocket over 30 years. The portfolio grew to $942,000. That means roughly $887,250 was created by compounding, reinvested dividends, and long-term market growth. The majority of the future wealth did not come directly from Josh's labor. It came from the system Josh built and continued feeding. That is the point. The goal is not to pretend that $5 a day makes you rich tomorrow. It does not. The goal is to understand that small, consistent ownership placed into the right long-term structure and left alone long enough can eventually produce results that look completely disproportionate to the original sacrifice. That is how compounding works. The early dollars do not look powerful, but they carry the most time. And time is the invisible multiplier. Most people lose because they do not respect that multiplier. They want the result without the waiting period. They want the income without the decades of accumulation. They want the snowball at the bottom of the hill without rolling the first handful of snow. But the system does not work that way. You have to start when it looks small. You have to continue when it feels boring. You have to stay calm when markets fall. You have to reinvest when the payments look insignificant. You have to let the curve form. This is why weekly investing can be more useful than waiting for a perfect lump sum. A lump sum requires you to have a large amount of money. Now, a weekly habit only requires you to begin. And because the habit repeats, it builds identity. You become the kind of person who invests every week. That identity becomes more important than the amount, because once the habit is stable, the amount can grow. $35 can become 50, 50 can become 100, 100 can become more as income rises. But if the habit is never built, larger income often disappears the same way smaller income did. That is one of the most important financial truths. A higher paycheck does not automatically create wealth. A better system does. If you do not have the system when you are earning less, you may not have it when you earn more. You will simply spend more. But if you build the system early, every future raise has somewhere productive to go. Every bonus has a purpose. Every bit of extra income can strengthen the machine. That is how you begin to turn time from an enemy into an ally. Inflation punishes idle money. Debt punishes undisciplined borrowing. Markets punish impatience. But compounding rewards consistency. The hard part is that the reward comes later. That is why the psychological side is just as important as the mathematical side. You must expect the early years to feel slow. You must expect market declines. You must expect headlines that make you question the plan. You must expect periods when doing nothing dramatic feels almost foolish. But if the portfolio is broad, low-cost diversified, and aligned with long-term growth and rising income, the most important action is often not to do something clever. It is to keep the machine running. This is why I always come back to principles. A good principle simplifies behavior when emotions are loud. The principle here is straightforward. Keep investing consistently, keep fees low, keep the portfolio diversified, reinvest the income. Do not let short-term noise interrupt a long-term process. Do not confuse a small beginning with a small outcome, and understand the difference between money that is consumed and money that is converted into ownership. When you spend money, it is gone. When you invest money, it becomes a claim on future productivity. That does not mean every investment works. It means the framework is different. You are building assets instead of only covering expenses. That is the difference between a paycheck life and an ownership life. The paycheck is important. It gives you the income to begin. But the paycheck alone is not enough. If every dollar disappears, the surplus must be turned into something that can grow. That is what Josh's example shows. $5 a day is not impressive at the beginning. $35 a week is easy to dismiss. But after 30 years, the dismissible habit can become the thing that changes the entire financial picture. That is why I do not look down on small amounts. Small amounts repeated over time are how most people begin. And beginning is where the separation starts. One person says, "This is too small to matter." Another says, "This is how I start." After 1 week, the difference is invisible. After 1 year, it is still modest. After 10 years, it becomes noticeable. After 20 years, it becomes serious. After 30 years, it can become life-changing. That is the nature of curves. You do not see the curve at the beginning. You feel the discipline before you see the reward. And that is why most people never reach the reward. They stop during the discipline stage. If there is one thing I would want you to take from this, it is this. Do not wait until investing feels dramatic. Start when it feels ordinary. Do not wait until the amount looks large. Start with the amount you can repeat. Do not wait until the economy feels certain. It never does. The economy is always moving through some version of uncertainty. Inflation, interest rates, wars, recessions, crashes, recoveries, elections, technology changes, and business cycles will always be part of the environment. The investor who waits for perfect clarity usually waits too long. The investor who builds a repeatable system has a much better chance of benefiting from time, and time is the most powerful force in the whole structure. This is not about getting rich quickly. It is about building a system that can make you less dependent on the next paycheck. It is about slowly creating an income stream that comes from ownership rather than labor. It is about understanding that the same time that weakens the purchasing power of cash can strengthen the productive power of investments. That is why the $35 habit matters. Not because it looks big today, because it can become big if you keep it alive long enough. And that is the lesson most people learn too late. The dollars that matter most are not always the largest dollars. They are the earliest dollars. They are the repeated dollars. They are the dollars that you place into a system and refuse to interrupt. If you can understand that, you understand why a small weekly deposit into a diversified Fidelity index portfolio can eventually grow into something that looks almost impossible at the start. The paycheck pays for today, the portfolio prepares for tomorrow, and if you let tomorrow compound long enough, it can begin paying you back every month. That is how a small habit becomes a large outcome. That is how time changes sides. And that is how ordinary consistency can eventually do what ordinary income cannot.